The local economy has narrowly averted a technical recession in the fourth quarter. According to Stats SA data, the gross domestic product measuring the total monetary value of all the finished goods and services produced within the country in the quarter increased by 0.1%. It's up from a contraction of 0.2% in the third quarter. The local economy grew by 0.6% in 2023. Stats SA says 6 industries recorded positive growth between the third and the fourth quarter of 2023. They include transport, finance and personal services industries. The mining and manufacturing industries have shown some resilience amid the electricity and logistics challenges the economy is facing. The mining industry recorded positive growth in the quarter with increased economic activities reported for platinum group metals, coal and diamonds. The manufacturing industry increased by 0.2%, with 6 of the 10 manufacturing divisions reporting positive growth. The transport equipment division made the largest contribution to the increase in the fourth quarter. The agricultural industry contracted by 9.7%, primarily due to decreased economic activities reported for field crops, animal products and horticultural products. The sector has battled various animal diseases such as the avian flu affecting the poultry sector in the past year. Well, to unpack the latest GDP data, I'm joined by Huntley. She's an economist at Nedbank. Thank you very much, Crystal, for joining us. So what's your reading of the 2023 GDP number as well as the final quarter of 2023?
Well, Nombulelo, good afternoon to you and also good afternoon to your viewers. Thanks for having us on the show. So you rightly mentioned all the statistics as to what occurred in the economy throughout the year and also in the fourth quarter. In line with our forecasts, we were expecting growth of around 0.3% for the fourth quarter. So we did see that growth surprised to the downside to 0.1%. What the discrepancy for us came with respect to agriculture. Our forecast was for growth of 5.9% within the agricultural sector for the fourth quarter. And as you said, what we ended up seeing was a contraction in the agricultural sector. The outcome is not necessarily surprising given the context that we find ourselves in. So on the one hand, there are the structural factors, the structural impediments such as a large amount of load shedding, power shortages within the economy. We also have the Transnet woes with respect to the port and the rail infrastructure inefficiencies, the backlogs and the wait at the ports that have really weighed on the industrial side or the production side of the economy. And then with respect to the demand side of the economy, you've got a really high interest rate environment, both domestically and globally. You've got elevated inflation. So this tends to weigh on demand. And you then see this filtering through onto wholesale, retail, trade and motor vehicle sales within the tertiary sector.
Yeah. So, Crystal, what's the outlook for growth this year and jobs growth as well?
Our outlook for growth this year is for growth of around 1% throughout 2014. What we see happening is a year of 2 halves, basically. In the first half of the year, you're not going to be seeing any reprieve from the structural impediments that I just mentioned. Yes, rightly so, there are plans in place to address the structural impediments that we're facing. However, we haven't seen much traction or much implementation of the plans in place. And we would really need to see movement on this regard for the production side of our economy, mining, manufacturing, construction, to really lift off also investment because it would improve sentiment. And then with respect to the demand side of the economy, in the first half of the year, you're still faced with elevated interest rates, a weak global environment, weak domestic environment because of the higher prices, high interest rates impeding on demand. So you still have softness and weakness within the first half. However, as you move into the second half, when we start seeing a drop in interest rates and inflation coming down, then you see the strain on the consumer slowly but surely starting to lift. Granted that there is a lag between those drops and then the increase in demand, but you do start seeing, especially with respect to the drop in inflation, you do start seeing your discretionary income starting to increase and consumers able to consume a little bit more.
I know it's your job to make lots of assumptions, but I love it that in your response you make the assumption that we're going to begin to see interest rates come down. But what I wanted to ask you now is on the consumer side of the economy, how do you see us faring? I mean, for example, we're hearing that we're going to have to pay, a whopping increase in fuel prices come midnight tonight. How do you see us faring for the balance of the year?
So, like I said, in the first half, given elevated interest rates, high inflation, and how that eats into your disposable income, your discretionary income, this rise in fuel prices is going to eat a further proportion of our discretionary income. So the pressure on the consumer is really mounting within this first half of the year. But as prices start to slow in the second half, you do see that pressure lifting a little bit, somewhat.
And in terms of, you talk about the interest rates coming down. When do you expect them to come down exactly? And to what extent are you concerned about global factors perhaps slowing that possibility down? Because we know that there's a lot going on in the world that doesn't augur well for inflation or for interest rates.
Our forecast is for a first interest rate drop in July of 25 basis points. Thereafter, we're forecasting another 50 basis points throughout the year, so that would bring the cumulative drop in interest rates to 75 basis points. With respect to the global economy, risks do appear to be on the upside. However, what we're seeing is there has been a significant drop in global inflation. We are seeing global inflation drop down to advanced economies, 2% target range. In emerging market economies, we've already starting to see a slow decrease in interest rates, with Brazil being the first mover on that front. With respect to the other risks that we see coming through, like with the geopolitical risks that has some upside risks to the fuel prices that we might see coming through, we do think that risks on this front are somewhat subdued, and we're not likely to see prices go back to the highs that they were in the last 2 years.
All right, Crystal, you do sound rather optimistic. I hope you're correct. That's Crystal Huntley. She's an economist at Nedbank.